the magic of moving averages. Now, moving averages help traders make effective transactions by aiding them in evaluating a price history of a currency pair or related investment. More specifically, these averages make it easier for investors to interpret price fluctuations of an asset by smoothing out the random movements. Now, as we know, price doesn't move in a straight line. Price doesn't move in any type of random fashion. Price moves like this. Even it may be moving up, it could be moving sideways, it could be moving down, but it's hard to decipher. Moving averages help us take the noise out of the markets. They help us see how the price is moving, how the trends are moving. Now, moving averages, because they're done on our charts, fall into the area of chart analysis or the larger area of technical analysis. Now, technical analysts have harnessed a wide range of indicators over time, but the moving average stands out due to its simple, practical, and useful. By using it, traders can identify price trends as well as support and resistance of a security in question. They can also be incorporated into many different trading indicators and strategies. Now, a moving average is an indicator, and it is a lagging indicator because it accumulates previous prices and then divides them and puts them onto your chart. Now, we have everything from simple moving averages, which are the most lagging of indicators. Now, when I use the word lagging, indicators are broken into two categories. We have leading indicators and lagging indicators. Leading indicators try to foretell future price movement. Lagging indicators tell us something that's, or confirm something that's already happened. Almost every indicator, because it's using opens, lows, highs, and closes from previous periods, are always lagging indicators. Now, to negate or reduce the effect of lagging indicators, we're always coming up with new formulas. So a simple moving average, like a 10-period moving average, and if we're using a 1-hour chart, would take the 10 past 1 hours close, add them together, divide it by 10, and put a dot on a chart. We have other ways or other slightly various calculations that help us give more significant weight to the most current time frame. And these are called exponential moving averages. Now, a simple moving average is very simple. It's easy. All of us know what an average is. It's whether you're talking about your average bank account, whether you're talking about the average days in a month, whether you're talking about the average price of a home in your neighborhood. We get it by adding together the values and dividing it by how many values we put together. Now, the exponential moving average is giving more importance to the most current price level. So for instance, if you had 4 houses in your neighborhood all sold for $100,000 a piece, well, what would the average of the houses in your neighborhood be? 400 would be $100,000. If we had 3 houses that sold at 100,000 and one that sold at 110,000, if you added them all together and divided them by 4, the average price would be 102.5. Not much of a difference. But if 3 of those houses had sold a year ago at 100,000 and that sale at 110,000 was just yesterday, well, that's much more important because that value in today's market is higher than the value in the previous market. So an exponential moving average would give more weight to that 110,000. And therefore that moving average might be calculated at, say, 105,000 instead of 102.5. Now, let me pop up a live chart here for you. Okay, so I'm going to drop in my chart a simple 30 period moving average. That's the purple line going across the chart. And this is based on the close. Now, unfortunately, or fortunately, we have all this modern development in computers. These guys who are developing advanced charts, these developers are developers. They don't know anything about the financial market. And they're just told to do something. And what happens is they give us too many variables or too many choices. So when I first started trading many, many years ago, when we were hand charting, a moving average was always the close period for that, the close for that period, and divided. Today, we can use inputs that use the close, the open, the high, the low. You can have the high and the low divided by 2, the high, low, and close divided by 3. You could even have the open, high, low, and close. You could take a moving average of an EMA. All of these things that really offer too many choices, because what happens is you find some smart market guru that tells you if you use his formula, which might be a 30 period moving average using an OHLC divided by 4, and you do this and that and this, you're going to get a perfect trading system. The fact is, the closes work very well for everybody, but I have to tell you, today you have all of these choices. Now we're going to talk about time frames shortly, but a 30 period moving average is the last, and we're looking at a 1 hour chart, would be the last 30 1 hour closes added together and divided by 30. And we would put a dot at the chart on the chart, and we would connect all those dots with a line. And this would give us a moving average. Now, this moving average, as you can see, helps us see price movement, because price, now we're looking at a live chart, and we're looking at my teaching chart, which is my standard chart. And we see prices moving actually in a beautiful uptrend. Push, ease, push, ease, push, ease, push, ease. And we can also see how well that movement is supported by that moving average. Now, there's something called red light, green light with moving averages, and it means that we would only consider a buy or long position if price is above the moving average. If price is below the moving average, we would only consider a short. So in other words, at this point right there, we would never be thinking about buying into this asset. So let me get these markers off of here for us. Now, because our moving average is a lagging type average, we've come up with what's called an EMA, an exponential moving average. Which is a much more involved calculation. Because, like I said, it's giving more weight to the most recent time periods. Now, as you can see now, what you see on the chart is a 30 period EMA in the red, and you see the slight difference between the two different moving averages. Now, there's also all kinds of strategies using multiple moving averages. But today, right now, we're just talking about the difference in the two types of moving averages. Now, most indicators today and most traders today use an EMA as opposed to a simple moving average, because it does take the lagging effect out of the indicator itself. So calculating the EMA is a bit more complicated, as the indicator gives greater weight to the most recent values in order to reduce the effect of lag. To determine the moving average, a Forex trader should begin by selecting a time period, for example, a 10-day or 10 time period, and then calculating its SMA. Next, the investor should figure out a multiplier he will use to give the most recent data point greater emphasis. The size of the multiplier will depend on how long the EMA is, and it's a standard multiplier. So to calculate the multiplier, one can use the following formula. The multiplier is 2 divided by the number of periods plus 1. So in other words, for a 10 period moving average, we would take 2 divided by 10 plus 1, which is 11, and add that, we've added the 1, and that gives us a 0.1818, or an 18% weighted average multiplier. And we take that most current period and multiply it by 8, or add to it 18% to give it more weight for the most current future. So once the multiplier has been acquired, the following equation can be used. We take the multiplier times the closing price, and then we subtract the previous day's EMA and add the current day's EMA, because we're taking away one period from the far end and adding the most current period. An exponential weighted moving average puts more emphasis on the current price. While many don't grasp the difference between the two, there is one, and it's significant. And you can see below, or saw on my live chart, the difference between those. And now when you're going to make a trading decision or analyze the markets, it's important. Then when you're using indicators like Bollinger Bands or MACD that use a center line or a moving averages as a base calculation, it's even more important. Now, we also have another type of moving average. It's very rarely used, only because volume's a very confusing thing. And this is a volume weighted moving average. And it's a simple moving average that considers the volume traded during that period. Today, getting volume is a very iffy situation, because if you're looking at, say, stocks, we can get pretty much an exact volume from the stock being traded on the exchange at the moment. But in most cases, we're trading a stock CFD, and that volume reflects the volume either traded with the broker or volume traded with the liquidity provider, because a stock CFD is not actually traded on the exchange. So if you're using exchange volume but trading a stock CFD, it gets a little bit wacko. So most people have moved away from using volume weighted moving averages, unless you're a strictly stock trader and trading with a stockbroker. Now, in the Forex market, there is no way to get volume, because there is no exchange for the Forex. So we get information from commercial banks, central banks, brokers, or liquidity providers, but we don't get actual volume. So keep in mind, no matter what you're trying to use volume for, and if you're putting volume on your charts, it can be very misleading. Now, the volume is irrelevant in Forex trading. Any volume indicator offered by a Forex broker shows only the volume traded at the broker. It doesn't represent the volume of the whole market. While it offers an educated guess, it's just a guess and not a certainty. Today, we get this information from the data feeds we're getting into our seat. So it's not the volume traded by just the broker. It's usually the volume traded by the overall liquidity providers, which are much, much larger than the brokers. The newest kind of moving average, and one that I use a great deal in my trading, is called a displaced moving average, something most people haven't heard about. And it uses the calculation for a simple moving average. So it doesn't change your formulas. Now you can use it with an EMA also. What it does, it takes and shifts the calculation. Doesn't change the calculation. It shifts the dot on the chart. And I love DMAs. Okay. So what a DMA is actually allows us to cheat a little bit. It's the same formula as a moving average or SMA, but we shift the dot forward on the chart. So let me take you back to the live chart and show you this. And it works, what I find, extremely well. Okay, let me turn off the EMA. Now we're looking back at my 30 period moving average, the purple line, simple moving average. Now, all we do is we can use an offset. And what it does, it shifts. Sorry, I just clicked on the, watch the moving average on the screen as I see what happened. The moving average calculation didn't change, but the dot that was on our chart here has been shifted up 6 time frames. So it's actually moved that moving average a little bit forward. Okay. Now you can use whatever displacement you want. I use a 3 period displacement. So in other words, because my moving average is already 1 hour behind, because I'm using, if I'm looking at a 1 hour chart, it's already 1 hour behind. I wanted to help predict the future, so I'm displacing it by 3. And it doesn't throw your charts out of whack. It's not a new formula. Oh, come on, 3. And it gives you a lot better response. If you do this, the same thing with your indicators like MACD or Bollinger Bands, it also moves that indicator up because it's using that calculation. And this is one of the offsets of all these developers giving us all of these choices. And it's become larger and larger and larger in usage, because all you're doing is making up for the lag time. You're not really predicting the future. You're not changing anything relevant, it's really relevant. What we're doing is we are moving from now, because we have these formulas. We have, like I told you, these wacko gurus out there who come up with all things about backwards, using negative numbers. Some that are preaching stuff using 10 times this and 10 times. Some are out there saying, use a moving average crossover and use a 3 period displacement and a 20 period. These are all far out in the realm of never land, but you'll hear about them. But if you just use a 1 or 2 or 3 period, you'll find that it makes whether you're using an EMA or an SMA, it makes it a lot more satisfactory. The results is fascinating. Important support and resistance levels result using the same moving average, meaning only that a small trick influences the outcome. And again, this 10 period, it's shifting things out of logical meanings, using minus ones. Why would you want to move something backwards in time? So once a trader has calculated one or more moving averages of security, he can use for a wide range of purposes. Many investors utilize these indicators to determine what trend a security is following, to take the noise out of the markets. For example, a currency pair could follow an uptrend or a period of rising values during a time frame. Most investors seek to identify these trends and try to profit from them. Alternatively, security may do the opposite. And we might see that something looks like it's trending up or trending down, but when we put the moving average on there, we see more that it's congestion or a mess. Then we can also use multiple moving averages. And these are all, there's all different types of formulas. You can use a 10 and a 20 period. You can use a 30 and a 60, a 30, 60, 90, which is my favorite. Okay. And you can use a 3 different moving averages. But these give us what we call moving average crossover strategies. Now, a simple one using 2, in this case, we're using a 9 period moving average and a 20 period simple moving average. But see where we have the crossovers? When one moving average crosses the other, when a shorter crosses the longer, we get buy signals. When it crosses the opposite way, we get sell signals. And this is called a basic moving average crossover strategy. Now, investors should keep in mind that whether security is rising or falling in value, there are many different ways to try to generate returns from either its rise or its fall. For example, as long as an asset are climbing in value, investors can simply buy them to obtain profits. They can also generate returns from depreciated securities through strategies such as shorting. Now, I've mentioned different time periods, and this gets confusing to a lot of traders because you're using multiple chart time frames. So I'm using a 1 hour chart or 30-minute chart or a 15-minute chart or 2-day, a daily chart. Your charting is your personal decision as to what you're going to look for environmental reasons, what you're going to look at in short-term reasons, what you're going to look at to generate exit and entry points. I always look at a 1 hour chart. I never go back farther than I might look at a 2 or 3 hour chart to see environmentally, is this asset trading in a longer term uptrend or downtrend? Where is it overall? Then I use my 1 hour to see what is happening in my 1 hour to decide whether I would consider a buy or a sell. And then I go down to a 30-minute to start determining what filters I want to use. And I use a 15-minute chart to enter the markets to get my exit and entry points. But that has nothing to do, well, it has something to do with moving averages, but that's how you use time frames in your charts. Moving averages use different time periods because whether you're using a 15-minute chart, a 1 hour chart, 2 hour chart, you're using a 10 period moving average. If you're looking at a 1 hour chart, it's using 10 1 hours. If you're using a 10 period chart and you're using a half hour chart, it's looking at the last 10 half hours or looking at the last 5 hours. Now, an individual focusing on short-term trading might hone in on how a currency pair did during a 20-day. And we just refer these as day, but it's a 20 period moving average, as doing so will provide a sense of how the pair performed in its comparatively short time. One more use of moving average is to measure the momentum of a given security or how quickly it's either ascending or descending. The whole point of determining momentum is that once an asset starts moving in a certain direction, it will likely keep going in that same direction for a while. If a trader can identify the momentum of security, he can buy or sell the asset, or even take out long or short positions. To single out this momentum, an investor can look at what the financial instrument did within the short, medium, and long term. So for example, if a Forex trader wanted to ascertain the short-term momentum of the euro US dollar, he could look at either a 20 period SMA or EMA. If he instead desired a better sense of the pair's long-term momentum, he could look to measure it back over 100. For us, more than 90 is a big waste of our time, whether you're using a 1 hour chart, a 30-minute chart. And like I said, I use a 30, 60, 90, and I'll show you the fanning method ultimately, but the fanning of three different level length moving averages can help you understand exactly what a trend is trying to tell you. So if an investor takes time to master the moving average and the many benefits it provides, they will have an access to a wide range of tools that they would not able to harness otherwise. With these implements, traders can make better informed decisions, increase their chances of meeting their investment objectives. Now, in theory, there are an infinite number of simple moving averages. But if you're thinking that you will come up with some weird 46 SMA to beat the markets, let me stop you now. It's important to use the most common SMAs, as these are the ones many traders will be using. While I do not advocate you following everyone else, it's important to know that what other traders are looking at for clues. And to be honest, if you change a 40 to a 42 to a 43, the significance is going to be insignificant to get you any better information. Now, the popular moving average is a 5-period SMA. This is for hyper traders. They're looking for very short periods and using these for trade triggers. The most popular among short-term traders is a 10-period moving average. It's great for swing traders and day traders. A 20-period moving average is about the last stop on the bus for short-term traders. Beyond 20 periods, you're basically looking at primary trends. 50 periods are used to gauge midterm, longer term trends. At 200, I don't know anybody who uses a 200. Some traders will tell you that to try simple moving average trading is where you buy and sell if the price breaks the average on the closing basis. That's what I'm talking about, the green light, red light. We only use it for clues. Don't ever use it for a buying or selling system, because unfortunately this is not accurate. Oftentimes stocks will tick over or under the moving average only to continue the primary direction of the trend. But in the end, it comes down to what you feel comfortable with and what your trading style is. The EMA gives you more earlier signals, but it gives you more false and premature signals. The SMA provides less and later signals, but also fewer wrong signals during volatile periods. But when you are a short-term day trader, you need a moving average that's fast and reacts to price changes immediately. That's why it's usually best for day traders to stick with EMAs in the first place. A 9 to 10 period, a 20 to 21 period, and a 50-day to 60-day period. Now, as I was mentioning to you, this is what you're seeing on your screen is a 3 moving average crossover trading strategy. And even if you're not using it for strategy, it gives you a lot of information. So the yellow line on here is our 21-day EMA. The bright purple, whatever you call it, violet line is a 50-day, and the 10 period is the blue. Now, always when you're looking at multiple moving averages, you refer to the shortest time period as the fastest moving average. Why? Because it reacts faster, because in this case it's a 10-period moving average. When you have 10 periods, and so you're going back 10, dividing by 10, and you have a price shift in the most recent period, you're going to get a bigger reaction. That's just mathematics. The largest period is always referred to as the slowest. In this case, so a lot of things will refer to you as the faster and the slower moving averages. Doesn't matter what numbers are you using, is if you're using a 19 and a 47, the 19 would be the faster and the 47 would be the slower. Now, when we're using a 3 moving average strategy, what we see are 3 moving averages. Now we can start out over here to the left. And when you combine 3 moving averages over a long-term time period, you're going to get some very interesting results. Now at this point, We're coming off sideways congestion and we're starting to move into an uptrend. What happens? All three moving averages cross each other. But then the shorter period moving average, the 10 period, the blue line, starts to climb faster. The yellow line, which is 21 period, the middle, starts to fan in the middle, and the purple line starts to fan out. And what you get is a widening of that fan. While the fan widens like that, tells you you have a very strong uptrend. As that fan starts to narrow again closer, we're losing that momentum of that moving average. As they get closer and closer, as we get crossovers between the 21 and the 10 day, we get buy and sell signals. Now, what gets very unique in our interpretation, though, is how far the fan separates or comes together. Now, throughout the trends, price respected the different moving averages as support, and a break of the moving average is a significant signal. Now, here's the first time that all three EMAs closed above price and they crossed over. So having these three allow us to build a trading system or a filtration system or a decision-making system or a transaction system strategy, whatever you want to refer to it as. But these become very, very reliable. Now, swing traders have a very different approach, and they typically trade on the higher time frames and hold trades for longer. So they would use farther out moving averages. Okay. So once again, you can see this moving along closely. And then you can even go as far as 4 moving averages. I don't. But again, a 2021 period of 50, 100, and the 200 is way far out there, but that's for swing trading, not for day trading or short-term trading. Now that you know about the difference between the moving average and how to choose the right periods, we can take a look at 3 ways moving average can be used to help determine and find trends. One, we talked about already. It'll help us determine trend direction. By using something like a 10 period moving average and just watching for the red light, green light, it will help us determine the trend and the momentum of that trend. Here we're seeing 2 period moving average, another way to use it, which is the basis of what we know as the moving average crossover strategy. When the longer term crosses over the shorter term, it gives us a buy signal. When the price is below the EMA, it gives us a sell signal. Now, a lot of people won't even look for crosses. It only look for time periods that the price is completely below both moving averages or completely above, and they would call the territory in between dead man's land. They would never make a trade when the price is in between these. They would only make a trade below or above. Now, I don't use it, but a lot of people use moving averages for stop loss points. I don't, only because a moving average is constantly moving and adjusting. And for my stop loss, I want a very specific calculation. And then, as I mentioned earlier, the center line for Bollinger Bands, which is a very popular indicator, is based on a 20 period SMA and a standard deviation of 2 above and below it. But we've gotten much better using an EMA in the center as opposed to a 20 period SMA, and even some interesting results when we start using a 3 period displacement. So Bollinger Bands help us see the end of a trend or the beginning of a trend. So again, we can see how Bollinger Bands interacts with the moving average and will generate a buy or sell signal when the bands are the price is rejected by the bands, but not until it crosses the moving average. So you can see that moving averages are a multifaceted tool that can be used in a variety of different ways. Once a trader understands the implication of an EMA versus SMA and a DMA, the importance of the self-fulfilling prophecy, and how to pick the right periods, setting moving averages can become a very important tool in your toolbox. So thank you very much tonight for joining us tonight. I hope you learned a little bit about moving averages. Try to use them on your charts, and try a 3-period moving average crossover strategy, and make your own. Use a 10 20 30, a 30 60 90, a 10 21 50. Go online and you can find all the standard applications, but don't read what somebody else tells you to do. Find, based on your trading technique, what you want to use for short, medium, and long. Don't trade anything. Just watch it, and watch and see how price and the crossovers and the fans work together. So again, thank you very much for joining us. Have a great trading week, and thank you for supporting Exponential. Good night now.